Honestly, I think that he will be able to cut rates. The big problem recently has been an acceleration in inflation. That's a very narrow-based inflation focused on not very many categories of consumer prices. And I think the underlying background inflation fundamentals are still suggesting a decline in core inflation. The economy is slowing down. We saw that with Q1 GDP data. Money supply growth is still negative. And importantly, wage inflation is still heading lower. And we'll see whether that is confirmed again with the employment report today. But I think the inflation trend is still downward. It may take a few months for that to kind of reassert itself again. But with a weakening economy, I think the Fed will have room to reduce rates.
Okay, and we're going to be watching that closely. Paul, just on another topic, I'm speaking to you from Tbilisi, Georgia today, where we're expecting Japan's finance minister and the BOJ governor to address the moves that we've seen in the yen this week. What do you think the line of messaging is, the narrative from these top policymakers as we see yen testing 160 this week?
Well, I think so far they've been pretty secretive about what they're doing, which is quite common. They don't want to really give too many signals to the markets about what they're up to. They want to keep the markets guessing, which helps them with that element of surprise when they do take action. I think overall they will just emphasize that they want to avoid too much volatility. Maybe not emphasize that they're trying to influence direction. They just want to calm down the volatility, which I think had become extreme recently. Personally speaking, I think they need to do much more in terms of adjusting monetary policy. So the Bank of Japan itself actually needs to tighten rather than leaving up to the Ministry of Finance to effectively tighten via intervention.